Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, June 7th, 2024. It's 11:37 a.m. Eastern Time, so we're a couple hours into the trading day. And just give you a quick update. For the most part, a follow-up to yesterday's video, just covering the different sectors in the, or more so the euro. We're going to talk about the euro, stocks, and the miners, and how that all ties in together. So hopefully you caught yesterday's video, highlighted the euro at key downtrend line resistance. This is the daily chart right here, and you had negative divergence both here on the daily chart. You can see as I zoom in, these are your divergence lines. That's that major downtrend line, and as expected, it was rejected there. You had the divergent high, and then I gave you this little minor trend line break, which, I'm sorry, this minor uptrend line, I just dropped down to a 60-minute chart. And that's the one I got out to you this morning and also covered in yesterday's video. And that was it. That was on the hot jobs data. And I'm doing the video now because I see an opportunity. And I'm going to reiterate what I've been saying on this. There is a unmistakable correlation between the EUR-USD, that's the euro-dollar pair, the stock market, and the precious metals. And again, there are times, very brief, relatively brief periods where they may disconnect, but I've showed you the correlation hundreds of times over the year, especially lately. And that's the thing. When you look at correlations of anything, in this case, a currency pair in the markets and the metals, you want to see how's that correlation acting. Lately, is it still there? Because I've seen times where correlations have completely disconnected. We saw the inverse correlation from stocks and bonds disconnect a couple of years ago. That was the historical gold standard rule, the 60-40 portfolio, being that when stocks would go down, your bonds would go up and offset losses, and that was a way to smooth out the bumps. But investors got clobbered in that model got clobbered in 2022 when both stocks and bonds had horrible year. So either way, the correlation is there. That's the breakdown. That's the target I gave you. We're halfway there now. We were down here earlier today, and nothing but selling in the euro. And again, that's on our Strong's job data. So now here's the opportunity. The stock market did initially drop down pre-market. They've gobbled up a lot of that dip. I think it's an opportunity right now. Unless this reverses, one of two things is going to happen. I can all but guarantee you one of two things is going to happen. Either the euro will stabilize and start moving back up, and then that'll support the dip that they bought in the stock market. But if we continue down to my targets, especially below those, that's just, as I said earlier today, my near-term target right there. That's its intersecting uptrend line in the it's about 108 level right there on the euro US dollar. We're getting close to it, so most likely see buyers step in there. And again, that if stocks are still holding up, maybe that'll support the bounce and even give you a little more. However, we did, remember, this is just 60-minute stuff. That's a near-term target. Here's a trend line. If and when this trend line's broken, whether we get a reaction on it or not, it should open the door to more downside in the euro. And remember, that's 60-minute chart. It's easy to get lost in the world of the intraday charts, kind of zooming in and micromanaging positions and trades, looking at the near-term direction. But then the bigger picture says this. This is a primary multi-year downtrend line in the euro-US dollar pair with several key reactions. Each time we hit this trend line I highlighted at the time, divergent highs, looking for a reversal, and that's what happened. And then you broke this trend line, you had a big reversal. You did it there. Now, the reversals have gotten weaker lately. So this trend line could break, and if that breaks, again, that should be net bullish for gold, net bullish for equity. So that's certainly a possibility. So remember, I'm going to be gone for the next week and a half, almost 2 weeks, on vacation with minimal updates. I'll be in Italy. So, I'll try to get anything when I can, in between where we're staying and what we're doing. Anything big happens. So just take that analysis for what it's worth. Now, let me just show you the correlation here. Let's go back to that 60-minute chart. Let's turn off all the drawings, and we'll just do this real quickly. We can look at EUR USD, or we can just interchange it with FXE, because the euro US dollar pair, that's the euro against the dollar. This is the same thing when you look at it for an ETF. So FXE, we'll just look at that. And edit chart. Oh, you know what? Let's see how it looks here. What I was going to get to is the euro US dollar trades around the clock. So when you overlay and do a comparison to the stock market, for example, you see the lines are a little bit different. So we can do FXE, and then that looks a little bit better there. But either one works, right? You can just know that these lines kind of flatten out because you're seeing trades around the clock in euro US dollar. But there it is. The correlation's perfect. So they're still matching up the same points. The market. I remember when I put in SPY, which I did here in the purple line, that's showing SPY from 9:30 to 4 p.m. So it's going to match those points, and so okay, you cannot argue that correlation's not there. So now, what I'm getting at here is you can see the perfect correlation there. And there was a big drop back then in the euro right there, and then the stock market didn't get the memo right away, went down a little bit, but then got the memo when it saw that drop, built in the euro US dollar pair. So here's where I'm going. This is one of two things is going to happen. It's almost a certainty. Either to support the fact that equities had an initial pullback, knee-jerk, and they're about flat today. Everything's flat. I'm looking at ES, the stock futures of 0.001, 0.000, so we're flat for the day on both NQ and ES. I'm looking at another chart monitor. And so that's not reflected. We started to go down. So there's your opportunity, guys. Mean reversion trade if you want. You can pair it up. You can go long the euro, short, the equity markets, to try to close the gap, however you want. I think it's a pure play to me. More of a, I chart the euro to trade the metals and the stock market. But again, there's a correlation. It cannot be argued. It's very blatant. And right now there's an opportunity because one of two things are going to happen. Again, either the euro's got to go back up to support the fact equities have not followed this down, or equities down, or a combination there of both. Euro up, dollar, stock market down. And now gold and silver. So that's also an unmistakable, pretty tight correlation with periods of brief disconnect, as I talked about in the video yesterday. And I do quite often. There are periods of overwhelming supply or demand, meaning buying or selling pressure in gold, that can change this disconnect, but it's immutable for the most part for a reason. The simple mathematics I always talk about. It's dollar, that when looking at the euro, it's a way of tracking the dollar index. I just like the EUR USD, and gold being priced in dollars, that's simple. So dollar goes up, it takes fewer dollars to buy an ounce of gold. Dollar goes down, it takes more dollars to buy an ounce of gold. And so again, the relationship is very, very clear. You don't have to be an expert technician to look at a chart like this and see they both go up and down. There's those periods of brief disconnect, but those are opportunities. Usually you get a mean revert. I'm sorry, what am I doing here, guys? I've got to flip over. This is gold versus SPY. I should have done FXE for you, or EUR USD. Here, I'll do EUR USD. Good. There we go. There it is. So now this is the SPY right there, and then it was gold I wanted to show you as well. So we'll do. We'll leave it on EUR USD, and I'll change this to gold. That's what we'll do. That's what I was trying to get to here. There's gold. It's in yellow. Let me make it purple just so it stands out better. And you can see the relationship here. Again, there was that period of disconnect right there. There was a breakout in gold. That was a great example of when there's overwhelming, doesn't matter. When the gold broke out to new highs and it was a major clear breakout, everybody could see it, and everybody was buying gold, and it didn't matter what the euro was doing because the overwhelming buying pressure, despite whether the euro was going up or down, made gold go up. But then gold kind of, the breakout happened, the momentum slowed. That's why we've had this shorting up, and there it is. You can see the momentum return to its usual very, very tight correlation. One goes up, the other goes up. One goes down, the other goes down. Tail wagging the dog, doesn't matter. If you can predict where the euro is going, you can predict where gold is going. So this is what happened. So the euro right here, that's that drop this morning. Gold behaved exactly as it should, and silver. So this is what the stock market would normally be doing, and right now there's an odd disconnect. Hey, look, I'm going to give it points right now. The stock market is in one of those rare moments where good news is good news and bad news is good news. Bad news is good news for the stock market because they want a rate cut and they expect a rate cut. Today, the knee-jerk reaction because the jobs numbers came in a lot hotter than expected, stronger, and so that further diminishes the chance for a rate cut. Until recently, the market, and we've seen this, the market, when you have bad news on the economy, you've seen the stock market rally because it thinks the odds are going to go up for a rate cut. But then today you saw almost opposite. You saw good news on the economy, and the stock market initially took it as bad, but then gobbled it back up. But again, just look at the correlation. It's unlikely to last. This is back on gold here, of course, but see, gold did follow it down the way it should. And, yesterday, let me turn this comparison off. Chart properties, turn off the comparison. Futures. Oh, sorry. This is gold, GC gold futures. And yep, that was on Tuesday. We're right there. We had that bullish falling wedge. We had positive divergence. Every reason to cover short and go long. But as expected, it did lead to a bounce, but the bounce was limited, and boom, big reversal, and you had a gap down in GDX in the miners. Now look, we still have positive divergence. We're coming up to that. Remember, in the back on Tuesday when I covered, I suspected this scenario is what I laid out. We'd bounce because you hit major trend line. You're going to at least have a reaction there. We got that reaction, but then to go down lower when you have price support here. So this is probably your near-term downside. It's going to put in a divergent low if it gets hit soon. So keep in mind that if you exited and or got back into yesterday, I think was a great opportunity. No, I'm sorry. In hindsight, it was a great opportunity. Like I said, I figured that's where the bounce would end, so it was worth it to me. Put back on some silver shorts. And it did, but I think they're limited right now, the downside. Most of the moves already happened, in other words. So let's look at gold. So that was it. S2 rejected. We're down here, and we're at support right there, that T3 level, which was effectively hit right here. We're at it again. We reversed a hair shy of it there, and we're a hair below it now. And then this is that comparable support I just gave you on GC gold futures down here. If you're trading GLD, the price support level, which is about 211.46. So that is what I see as probably the near term, in the very near term, the maximum downside. It's not much more. It's about another 1% or so. And then that, if we hit it anytime soon, we're going to have positive divergence. You can see I just moved my divergence lines. And then silver working very well today. On the short side, also has some potential divergence and is coming up on support. SLV is a silver ETF, 2638 right there, and if it hits that anytime soon, it's going to have positive divergence. It'll be unconfirmed divergence, meaning the PPO needs to make a bullish crossover, but that's what I could see happening. So it would look like this. Come down, a little more downside. PPO crosses over, puts in a divergent low, and there's your trade. And if it, unfortunately, I'm not going to be around next week if this plays out. We could get more downside. I'm very much open to an even bigger correction. And why is that? It has to do with the technicals and the sentiment lately in gold. Just like the stock market, gold bugs have been tripping over themselves. To buy gold and bullish. So there it is. You've got really good support also here on the daily chart. Remember, 211.53. But on the daily chart, you're coming off this big divergent high. That's the first divergent high we've had since back here. And that correction played out over a couple months there. It took a couple months and a bigger drop there. Before that, we had this divergence. That took about 6 months or so down here. You can see and it was a much bigger drop. And so, as of today, I can only tell you that we're probably going to bounce right here, and it's an objective level to cover those GDX and gold shorts and silver shorts, or if you think there's going to be more, just when we get there down to those, set a relatively tight stop if you want to have the potential for a run or trade, much more downside. They may clip your stop, may not, but by doing that, you're only giving back a little bit of profits versus covering at those next targets I gave you. Again, 211.50-ish and whatever I just showed you on GC gold futures, and of course SI silver futures. So that's it. That's where we were yesterday when I figured the bounce was probably had run its course, and boom, we're right back to where I mentioned on Tuesday, covering those silver shorts because we'd probably bounce, and that was it. That was the bounce I was looking for. And now we're back to that level in a pretty impulsive fashion. And if it gets taken out, the divergence, at least here on the futures, will be gone. So these divergences are holding on by the skin of their teeth, meaning we have equal lows right now in the RSI right here, and lower, actually another equal low in prices, but overall lower lows, the trend from this point here when the divergence started, and you can see almost the same thing with the PPO. So this is where the technical case, at least here on the futures, in other words, the way I view trade, the way I trade the metals, miners, or anything like this, whether it's the stock market, QQQ, SPY, small caps, I look at both the futures and the ETFs, the index themselves. And my preference is to see all of them. Whatever I'm looking at is if I'm trading the NASDAQ 100, I want to see both QQQ and NQ ideally at support around the same time, ideally with positive divergences at the same time to cover shorts and or go long. Same thing with the metals and miners. So in other words, you'll still have it. I showed you a second ago on gold and GLD and maybe even SLV, but you're going to lose a divergence here on the silver futures. So what will happen is if and as each one of those four things I just mentioned, gold's the main one, and then the euro US dollar, let's not forget that. I always say, I've said this many times over the years, you'd be remiss to be trading gold and silver without following what the dollar and the euro are doing, or US dollar, EUR USD pair, because it just gives you that extra clarity, if you will. I think trading gold in a vacuum by just looking at GLD on the charts is like driving with a foggy windshield, or in a rain or a foggy day. When you're using the euro US dollar, it will help confirm or refute what you're seeing. So for example, you might buy a pullback to, let's just say in this case, silver's back to that 29.47 support we covered on the other day. And you might say, okay, well, Randy was right. It was support there. We did bounce. So support, that's even better now because we had that additional reaction on Tuesday that we didn't have before. So yeah, it's even better support now. So my point is you might want to go long silver. And hey, it may work. And you can certainly take a long with a shot, stop just below it. But if you were to do that, and at the same moment that you go long here, and I'm just using this as an example, gold is breaking support, or just broke support pretty impulsively. It's below support, triggering a sell signal, and then also the euro US dollar did the same. Well, guess what? The odds of this silver trade playing out are very low unless those prove to be whipsaws. So that's, in other words, whether you're trading silver, and you've heard me say it 100 times, I'm typically going to trade silver and or the miners when I'm bullish on gold. Why? Because I'm either going to be right or wrong on my call on gold. And if I'm right, I want to get paid more. If someone says, okay, you can, here's two coins will flip. One's a gold coin, one's a silver coin. You can call heads or tails, and I'm going to pay you, $10 if the silver coin hits, or you can flip the gold coin. I'll pay you $20 if your thing. It's that it works like that. So in a rally, when gold's going to go up, silver's going to go up more, and the miners are going to go up more. Likewise, if you're bearish on gold and shorting it, it's going to drop X, and then typically silver is going to drop a factor of X. So will the miners, and so. Anywho, but you do want to watch them all. I think they're important, especially gold. Gold tends to lead silver. And of course, the euro US dollar, you can call it, coincident indicators, if you will. They tend to, like I said, the correlation's tight. There's hardly a lag there. But when you can, if you are looking, if you're thinking about going long on gold and the miners because you're bullish, but then you're looking at the chart of EUR USD and it's clearly bearish. That's what I was saying. You have a bearish chart pattern and then a breakdown and a sell signal, and gold hasn't gotten the memo yet, then you might want to hold off and wait and make sure that breakdown in the euro fails, or hold off on your gold silver trade. Okay, hopefully that all makes sense. And so there it is. So as of now, right now, you are at support on silver. I will say this, if you shorted it yesterday at resistance, where I showed you GLD was at and everything else, you've made 6.25% in a single day. Either cover it now if you're an active trader, or set a stop if you think it's going to break and go through there. I'd say decent odds, coin toss odds. Why? Well, it may bounce first, but the reason why is what I got out to you this morning. USD, gold and silver are probably not going to stop falling until the euro stops falling, and my target is still a little bit lower on the euro. It's this intersecting uptrend line, that 108 level. So doesn't guarantee it's going to be hit. I think it'll be hit, and we could do this too. Like I said, minor zigs and zags aside, so we could certainly have a kickback rally first. It's that's the biggest drop we've seen in the euro since right here. But that one was followed by a little period of consolidation first, and then it continued. A little bear flagging action too in there. So, all right, last but not least, because again they're all related. GDX. There was GDX was pushing right back to that resistance level, and so you could have took profits on the bounce that we had off that when gold and silver at support the other day. 6.25% bounce, followed by a drop today of 6.5% so far, and that's swing trading for you. So there it is. You had that very bullish setup, but that's all we got. It's it's a nice trade, 2-day trade, but the fact that we got rejected pretty hard is pretty darn bearish, and that increases the odds we're going to go down, hit T2. You can see T2 is about the same distance down. My second target is the drop about 1% that I just showed you in the euro. So that says, if I'm right, we're going to drop. Whether we kick back or not, hard to say, 50-50. Either way, it's still, I think we go down here, drop another percent, and at that time, the euro will probably be at support too, and then you can, cover a short if you haven't done so already, or try to game a bounce. But if, like I said, if we break that support, that uptrend line on the euro, that minimum near-term target, we're probably going to come on down pretty quickly to T3. This whole thing here, especially towards the end, is a one-sided trade. It's a hot money trade, kind of like NVIDIA. Mark my words, that day is going to come when all of a sudden everyone, for whatever reason, they want out of NVIDIA, and it's like screaming fire in a movie theater with one narrow exit, one single door exit. You can get when everyone's one-sided bullish on one side of a trade. That's what tends to happen. Those pretty quick moves down. That's still a potential swing target, but I'm not going to be around if and when it's hit. At least not if it's going to be hit in the next. If it's going to be hit, it'll probably be hit within the next a couple weeks when I am out. And there's a big thin zone here on the volume and price histogram right there. You can see these green and red bars. Thin zones work a lot like gaps. That's T3. So if T3 gets taken out, you've entered the thin zone where very few bought right there. You had a bunch of buyers there and a whole crap load of buyers above. And so that's why that would be quite bearish. So there it is. That's your analysis for the next few weeks in the metals and the miners. Let me see if there's anything else I want to cover. Nat gas still doing its thing. Remember, we already had a divergent high, gave us a correction back to the trend line. That was our most, was this right here? Yeah, this one of the, I think right here, our most recent re-entry after milking almost all of that run up to there, then turning around, came in a little on the pullback there, and then going long here for a new trade, and sidestepping that. That was a pretty healthy correction. But this is nice price action. I wanted to just update it here. All these reactions on this uptrend line, highlighting these pullbacks as an objective long entry, and again, as I said the other day, as would be another pullback there with a stop somewhat below it. But I wanted to point out we're coming up on T4 now. That's the next price target, and then I did tell you additional targets to be determined. I've covered the long-term chart, and I also talked of the nature of UNG. When she wants to run, she can really run. Divergences don't bother her too much when she's in rally mode. After again that initial run, which was 50+%, yeah, you're going to get a big divergent high. You're going to get a correction somewhere in there, and that's what we got, and that's what we sidestep. So that's it. So the next target, on UNG, but I always say align your targets on UNG with those on natural gas. But you have the uptrend line, which is right around the same spot. I gave you that. I believe there's a target on nat gas. But again, bigger picture is long term, and that is this thing's coming off a big divergent low. I've also showed it to you on nat gas futures. I know UNG doesn't do a perfect job tracking the price when you go long term back many years, but in the near term it most certainly does. And you can see there's still there's a big area there of a big trading range that at this point I think it's very likely we're going to go up and test the bottom of that trading range. It may not come in exactly at 24.90 anymore because of the kind of the slippage that this ETN has trying to track, or they're calling it an ETF here. It always was an ETN. I don't know if they changed it or if that's a misprint. But anyway, that would be another 26%. And then let me go back to the futures. Yeah, I just jumped out to a 2-hour candlestick chart. So it goes back 6 months instead of the 3 months we were looking at earlier. I'd say probably come somewhere around that previous reaction high. You have reaction highs here, and that one's a little lower. So somewhere in there would be your next additional target. But either way, it's established. It's clearly in at least a near-term uptrend. The longer-term trend you could still say is bearish, but remember, I covered this on the daily chart of the long-term natural gas futures, the continuous contract, and we're coming off that big divergent low, which historically has had those very high double-digit, even triple-digit rallies, 100+% runs. So that's that. And again, unfortunately, I'm not going to be around the next couple weeks to give you an additional updates, but there it is. You have the trend line. That's it. So we take out the trend line, especially if these divergences. Let me step back down to the 60. If those divergences happen to play out, I have to acknowledge them. That's a big part of my trading. Then you could hit T4 and have another correction that could even, take us back down to and possibly below the trend line. So it's up to you. If you're, an active swing trader, game the reactions off these targets, especially when you get divergences and, reload back in or short, buy back in. Be careful shorting nat gas right now. The primary trend is bullish, and like I said, when she wants to run, she can really run, and tends to quite often burn through divergences in the early stage or even the mid part of these bigger trends when you go out on the longer term daily chart. All right, guys. The only other thing I wanted to touch on real quick are bonds. With the smackdown in the dollar today. The smackdown in the euro, which is a rally in the dollar based on the stronger jobs data. We had obviously a reversal in bonds. So remember, ZB, the 30-year bond, just recently broke out above this primary downtrend line, and it's effectively back testing here. I have it a hair below it, but when I look at TLT, we're a little bit above it right now. So this is, you can see it on the daily chart right here. And this is a 60-minute chart right there. So TLT is above that, so nothing more than a back test at this point. And ZB, again, the 30-year bond futures, close enough in proximity to that trend line that they may step in here and buy treasuries, would be my guess right now. So on the back test again. And again, maybe not, but what I can tell you definitively, it's always objective after a breakout to buy a back test. With a stop somewhat below in case it fails, somewhat below the trend line. We may backtest for a couple days, who knows, but your stop would be below the trend line there. And then, but what it matters is this is an uptick in yields, and it brings IEF, the 10-year, which is considered by most market participants even more important than the 30-year bond. The 10-year is back into my orange zone. So remember these zones from back a while ago. So we had a brief period where we spiked out of it, just like we did here, and got rejected back down. We're back in the orange zone. And guys, if you remember when I was covering this, I've had these zones for months now, and they've worked well, especially when you enter those and start moving down, because that is, remember, bond prices, which we're looking at here, are opposite rates. When it's bond prices, when the 10 year is dropping, it means the yield on the 10 year is going up. And so I said back at the time that these levels, although they are, clearly, labeled what they mean to the stock market, but more important is it's not so binary, black and white, all or none. Oh, you're long stocks here in the green or yellow zone. It's also a function of time. I was explaining that the longer yields stay elevated, meaning bond prices stay down low in this orange zone, even in the yellow zone, the more bearish that is for the stock market. And that has to do with the tremendous amount of debt servicing that's coming up later this year and into 2025. And so they've called it, there's like a mountain of debt. A lot of corporations have to refi. You can see that today in this pullback in bond yields that, you saw the initial pullback in the S&P 500, right? Let me go to 1 minute chart. It's pre-market. You don't see it here. I don't have my pre-market levels turned. They bought up the S&P. They bought up QQQ, big caps, which are less rate sensitive. Small caps are the most rate sensitive of all, and they're down pretty good today. They're down about 1% after being down as much as this morning, 1.4, but they're still well in the red today, and because they are the most rate sensitive. Those companies depend on debt and financing, and typically companies refinance out about 5 years. And so what had happened during COVID and the historical low rates, there was a massive amount of refinancing. So everybody and their brother, any company that had debt, even companies that didn't need debt, like Apple and those, they borrowed money because the rates were so cheap. And like I said, most corporate loans on average about 5 years. And so that was, COVID was 2020. And so here we are. We're coming up on that now. 4 or 5 years is really what it is. So yeah, we're coming up on where a lot of those companies are going to have to refinance. And so the fate of the small cap index, IWM, the small caps in general, is largely, if not exclusively, going to depend on this, where this goes, where the rates go. This is IEF, which is the 10-year bond. The rates are, you just look at TNX if you have a TC 2000, and there's the yields. And there's the weekly chart. I haven't covered it in a while, but I've covered this many times in the past. My long-term view, I believe rates have started, and I have no doubt, everything in the technicals say they've started a new secular bull market, the secular bear market trend in interest rates, a nearly 50-year downtrend that started back in 1981 with falling rates, ended here. So by every technical metric, including but not limited to the primary downtrend line, that was a clear downtrend line, that's been taken out. We've taken out previous reaction highs, so you have a series of higher highs, higher lows, and nothing lasts forever. So that was, again, we're coming off a generational trend, 40-plus year trend of falling interest rates, which were very bullish for equities. And so now it's a matter of, this is very long term, but near term, where do we go from here? The scenario I've been laying out for a while and I'm leaning towards is that we will continue to tick higher before we have a meaningful reversal in rates. And so that would be these purple lines I've drawn. I've added that back on actually in December of 2023, that scenario that we would extend the divergence right here. So we're at uptrend line support. If you look at kind of more shorter term, you've got the uptrend line right here. This is our divergence line. We had a divergent high there, broke down, yields fell, bonds rallied. We were in right at the bottom there on TLT. We went long. That's when TLT rallied because the rates were falling, even though I'm looking at the 10-year here, 30-year did the same thing. And so this is where I suspect we'll go another thrust up. That'll take rates to new multi-decade highs, at least multi-year highs, I should say. Yeah, multi-year highs. Yeah, decade goes back. When we recently touched where rates peaked back at right before the financial crisis. That was when the last bear market ended. It was October of '07, right there, and then this started the financial crisis. Those big drop offs, so all those bouts of quantitative easing, and then there's the nuclear option when COVID hit, with rates going down to the floor. And so anyway, that's where I see us going. So if we tap on up here, that would mean rates are going to continue to rise in the next few months, which is not what the market expects. And you can see, I'm supporting that case technically, as long as a case can be supported technically. One of those is the PPO above the zero line. When the PPO is above the zero line, which is right there, like it is now, the trend is bullish, meaning rates are going up. When the PPO is below the zero line, the trend is, you got it, bearish, right? Simple stuff. And so it's not be all end all, but it's one thing, and it's one thing I'm looking at. And as long as this line keeps holding above the zero line. Now, if we cross solidly below on a this is a weekly chart on a weekly basis, we break this trend line. Well, guess what? We're probably going to go lower in rates, and bond prices will rally, and that could be net bullish for the stock market. But at this point where we're at, it could just as easily be bearish if it's a flight to safety bid. So, but while that may seem like a waffly thing to you, I don't think it is at all. I'll be watching the technicals. What I can tell you definitively, without any, no, it could be this, could be that. If rates do this, if we go and take out those previous highs, even get to them, again, it goes back to simply just watch my zones. There's no scenario I see, absolutely none, zero, where that is any way, shape, or form bullish for equities. Again, if we enter, IF goes down here and enters my red zone, takes out the bottom of the orange zone, rates are going to go up, and stock market is going to come down kicking and screaming with it if that happens. So and here's the thing, we'll just watch. You have the levels to watch. If those if resistance levels are broken, support levels are broken, then that's going to change the trajectory. All I can tell you definitively right now is we're back in the orange zone, and rates have remained fairly elevated. That was the peak right there in rates when the market bottomed in October. Like I talked about, there was no coincidence. That's when the stock market bottomed, when yields peaked and bond prices bottomed. That was the fundamental catalyst for the rally in 2022, the falling rates, rising bond prices. And that's when momentum started to stall out. And here we are, trading, if you look at the market from a bigger picture, right here, we're back now basically trading exactly less than 2% where we were back in March. So this is where we've gone down, we've gone up a little, but this is momentum stalling. This was fueled by falling rates. Then this was the first spike up in rates. Then we had the abatement in rates here. And now we need to, where the market goes will depend on where rates go. And that's that. All right, let me wrap it up here. So that's the gist of it. Keep an eye on the euro. Gold, the euro, all those coming up close to support now. If you want to milk out another 0.5%, 1% maybe, is it worth it? If you are, just keep stops, relatively tight stops, because they might reverse a little shy of those levels. Again, silver's down, what I say, over 6%, and you want to milk another one, and it's at support too, so might be a good time to cover those silver shorts if you shorted it yesterday or reshorted. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.